The earnings that are being put out today, I think they're very suspect. The guidance you're giving doesn't talk about stock compensation. They ignore restructuring costs. They don't amortize intangible assets. They ignore the cost of taking over another company. We say, oh, there's synergy. And yeah, it's like taking a drug, borrowing money very cheaply, taking over another company. You feel good. It's like steroids. The athlete's jumping pretty high. And so those companies, they can show a huge EBITDA number that we all know is not going to be there in 2-3 years. Look, I know this stuff. I've taken over companies. I understand the way of it. So these earnings are fallacious. And another reason they're fallacious is a lot of companies that are doing buybacks shouldn't be doing it. When you start doing those buybacks, what it does, it's short-term fix, but it weakens the balance sheet. Now, I have been a proponent for buybacks in companies like Apple, where they're sitting with $200 billion in cash and not a lot of debt. They should do buybacks, and especially in Apple, where the stock is 9 times earnings. But you have companies today, these are companies I short, selling at 30 times earnings, 28 times earnings, and have no net worth because they keep buying back stock. And yet, analysts look at it quarter to quarter. If your earnings went up for the quarter, your stock goes jumping up. And now a lot of CEOs are just want to just see quarter to quarter earnings up, see the stock up. And yet, if you really do GAAP, which is a tougher metric, you haven't really increased earnings for 3 years. GAAP earnings, they've stayed at about $100 a share now for 3 years, and even GAAP earnings are suspect, which means we're paying a huge multiple. But what is going to happen to that market? Who is going to buy your stocks when those earnings start coming down? And that's with low interest rates, which I think is another scary issue.